Does it feel like this economy has got this nasty undercurrent that most people are either too distracted or, frankly, too exhausted to even notice? Yesterday, the Federal Reserve finally pulled the trigger and cut rates by another 0.25%. Who cares? Not a big deal. The media machines are spinning this as progress, as if the Fed's stethoscope picked up the faint heartbeat of a recovering economy. But ask yourself this. If life is supposedly getting rosier, why is your wallet still taking punch after punch at the grocery store? Why are home buyers still gritting their teeth, staring at home prices that seemed locked in on a permanent climb? You need to face the basic truth. Inflation is stubborn. Prices aren't plummeting. They're still crawling upward, draining your finances at a slightly gentler pace, but still draining them all the same. You think these rate cuts are going to magically fix that? Think again. The markets were half expecting the Fed to promise a future full of deeper cuts, a parade of rate cut reductions coming down the pike. Instead, the Fed offered a more modest outlook. They tapped the brakes, not slammed, they tapped them. So now bond markets and investors are grappling with a new reality. We're stuck in a grind and certainly not in some grand pivot. And you, the home buyer, the advisor, the investor, where does this leave you? Let me tell you something. In times like these, the real estate market isn't just a place to park your savings. It's a strategic weapon against the relentless bite of inflation. Owning property can protect your financial future, even as prices bob and weave. Today, we're going to talk about how inflation, interest rates, and seasonal shifts in the housing prices intersect. I'm going to show you why now, in this messy in-between stage, might actually be a shot at something better. So do me a favor, buckle in. We're diving headfirst into this chaos and cutting through the noise. All right, let's get right into it. Inflation is a persistent thorn in your side, and it's not going away just because the Fed trimmed rates yesterday. For anyone who's been living under a rock, inflation doesn't just vanish the moment the Fed nudges a rate. Sure, the pace might slow, but prices are still marching upward. You can see it everywhere, from the rent you pay to the cost of a simple meal. If you're feeling the pinch, trust me, you are not alone. Everything already costs a fortune, and it's not just in the big cities. This quiet, creeping assault on your purchasing power is happening literally everywhere. Now, one of the smartest shields against this inflation beast is real estate. It's been this way for a long period of time. Property tends to hold its ground when other assets get slapped around by the cost of the rising costs. Inflation might chew up the value of the dollar, but real estate often remains a stronghold. When money gets weaker, owning something tangible, something you can put your hands on, can anchor your wealth. This is where you, as an advisor or as a savvy buyer, step in. You can help people understand that even in chaotic times, even when interest rates are in flux, there are opportunities to be seized. Yesterday's Fed move took the federal funds rate down by 0.25%. Not a huge cut, but it's a step. It's a continued step in the right direction. Before this, the Fed's last forecast indicated they'd pull rates down much more substantially through 2025, envisioning cuts of around 1 to 1.5% or 1.25% from where we are right now. But now we've got a slightly different picture. After yesterday's action, the Fed's updated famous dot plot, those infamous little dots that show each member's expectation for future rates, it's clear. The Fed is becoming more cautious with its forecast. They're not promising a landslide of cuts. Instead, they're signaling that things could be more measured, more incremental. The bond market, notoriously sensitive, isn't exactly breaking out with the champagne. Take a look at the 10-year Treasury. it's blowing through the year. It's blowing through the roof on the yield side. Investors were hoping for a more dovish tone, a promise of deeper cuts ahead. Instead, they got a mild shift. The bond market is not going to love this. That is because it means interest rates may not retreat as quickly as some hope. Jerome Powell's remarks in the aftermath didn't promise a smooth ride, and uncertainty can push mortgage rates around. Today's slightly higher financing costs can sting, but remember, it also creates buying windows. When interest rates are not at their absolute floor, some buyers get skittish. I get it. It's more expensive. Those higher interest rates can be scary, but that can also mean better negotiating powers for those willing to step in right now and possibly refinance later when rates do improve. Now, what about the immediate future? In a couple days, we're looking at the Fed's favorite inflation gauge, personal consumption expenditures, or the PCE index. Last month's readings were decent, but not stellar. Here's the catch. The upcoming number is going to replace a particularly low figure from a year ago. That one actually dipped almost negative. That means even a modest reading will now look like a huge jump in inflation year over year. Don't let the headlines fool you into a panic. Inflation is rising for sure, and they're going to scream it from the top of their lungs, but it's not surging. It's just that we're comparing it to an unusually low base from a year ago. This is the kind of statistical quirk that can spook the market, pushing rates a bit higher in the short term. The core PCE, excluding food and energy, currently hovers well above the Fed's 2% target. We may see it pick up slightly from something like 2.8 to maybe even 2.9%. Not catastrophic, but not what the bond market wants to hear. Even a gentle uptick feels like a surge in interest rates, making mortgage pricing much more sensitive. Yet, if you can stomach a little volatility right now, you could set yourself up for a nice payoff later. Why am I so confident things will improve down the road? Because as we roll into 2025, the year-over-year comparisons for inflation get easier. We're replacing higher readings from the earlier year with fresh data that's less aggressive. This means inflation metrics will likely look tamer by the time we're deep into the first quarter of 2025. When inflation settles, mortgage rates typically ease, creating a sweet spot for both affordability and rising home values. That's your key window of opportunity. Keep your eyes on seasonal patterns too. Home prices often dip in the cooler months. This isn't a crash. It's just a normal ebb and flow of the calendar. Every year, prices settle a bit in the winter and then roar back to life in the spring. Those who buy during the quieter periods gain the advantage of lower competition and better negotiation leverage. When the weather warms and buyers flood back in, guess who's smiling? The ones who snagged a deal at the seasonal trough. Understanding these patterns set you apart. It's not about predicting doomsday scenarios. It's about recognizing the cycles that occur year after year. And let's not forget who's actually out there buying. This is interesting. The average age of a repeat buyer right now is 61 years of age. That means the baby boomer generation is still a dominant force in the housing market. They have equity. They are less rate sensitive because of that equity, and they actually understand the value of property because they've been buying it for so long. While younger buyers and first-timers may be more social media savvy and price sensitive, don't overlook the power of the traditional demographics. Baby boomers have the resources and the motivation to keep this market afloat and thriving for years to come. With all that said, let's talk numbers. Although rates feel high today, somewhere around 7%, maybe high sixes, for mortgages, the direction of inflation will likely improve in the coming months. As inflation cools, the Fed can cut further. Yesterday's quarter point trim might just be the start of a more extended easing cycle, especially if economic conditions worsen and unemployment rate rises. The Fed's cautious tone suggests they'll be more data dependent, but as inflation data becomes friendlier and labor markets soften, they'll have the cover they need to slice rates more aggressively. Lower mortgage rates down the line will boost affordability, lift home prices, and reward those who got in early. Remember, the real money in real estate often comes from buying in when conditions are lukewarm and selling or refinancing when the market heats up. We've just walked through a full landscape. Inflation's persistent. The Fed gave us a modest cut yesterday, but hinted they won't be as generous with future rates as previously expected. The housing market is far from collapsing. It's stable, brimming with equity, and poised to benefit from better rate conditions when inflation does ease. Seasonal patterns are your ally. Buy in the lull, reap the gains later. In the end, while yesterday's Fed cut won't immediately flood the market with cheap money, it's another small step toward a more hospitable environment. The key is positioning yourself now. So when rates eventually drift lower, the broader market wakes up to these improved conditions. You've already staked your claim. Inflation may be a pain. Rates may not drop like a stone overnight, but armed with the right strategy, you can turn these headwinds into a long-term gains. That's the bottom line. My name's Darren Hunter, and that's another Guaranteed video.